Hey, welcome to Dr. Frank's Finance World. I'm Dr. Frank, the bank, where I try to teach you something about finance so you make more money in the future. This is Valuation Part 2, and we start off with sort of I don't know, it's a rule, if you will, at least in my world of investing, which is liquidity is always a factor. I don't care if you're talking about stocks or valuation or anything out there. Liquidity for the firm, make sure they have money to pay their bills. Liquidity for the stock to make sure that the market depth is such so someone on the other side. Liquidity for the options that you might buy is always out there as well. So liquidity, it's obviously a factor for firms and their ability to pay their bills, but it's so many other ways it's pervasive throughout the world of investing. When you're talking about gathering information on companies out there, I think the question is always who has the best info? And that's a great question to ask. I love FinViz. I get a ton of information from there. I love Morningstar, actually has some pretty good information in it. I really like Seeking Alpha. That's another great place to get information. Even Value Line, we've done videos on those before. But ultimately, it isn't just the raw data you can pull. It's who gives you information about what's going on in the markets and where you might be able to gain advantage or not. And these two PDF files, half full or half empty, and the other one, Morgan Stanley, on the oil markets is worth paying attention to, at least in my 2 cents worth. So if we go back here, we see for half full or half empty, we have UBS. They actually had some pretty good research. I love the fact you may go, oh my gosh, it's 9 years ago or 8.5 years ago, November of 2014. That's the beauty of it all. These guys put it out in real time, and then you get to go back and say, were they right? And I think that's very, very helpful in seeing. There's only a few of them. I'll be honest with you, that when it comes to investment houses, that I really like their information. And UBS and some of this stuff is good. I also like the one that I'm going to pull up here, Morgan Stanley, I think, tends to have much more accurate information than most. And there's a couple others, but we'll get to those. So in the half full, half empty, they're actually talking about, where is the market? Should be looking at, it's a glass half full. That's exactly the question we're asking now, 9 years later. Are we going to have a recession? Is the glass half empty? Is it going to be up from here? Is the glass half full? And what I like about, the emphasis, if you will, from UBS is it's on the tactical preferences. If you just want to match the market, go ahead. But if you're going to take all the information you have and try to improve your odds, then you're going to be taking tactical bets. And I love how they put this out there. We talk about asset classes and forming portfolios and that type of stuff, the equities, cash, fixed income, commodities, and so forth out there. But they'd actually say, whether they would underweight it, which is what they do down here relative to the index, or whether they would overweight it. They would put more into equities than they would into these others normally, and they put a little bit more into large cap growth and value, but they're really about mid cap out here. That's what they're at. And they would underweight, in this scenario 9 years ago, emerging markets. And they would underweight all kinds of bonds out there they thought was going to happen. The fixed income, we maintain our preference for high yield corporate bonds over treasuries and emerging markets. So if you're going to have your money into something that's bond related, they would suggest that you have it here. Or what about foreign exchange? We favor the US dollar and British pound over the euro and the Swiss franc and so forth. So I think they have really interesting information. Here's a guy that goes further and talks deeper about what was really going on there. We are keeping a positive view on risky assets and adding to our overweight positions in U.S. equities after adding to high yields last week. Our overweight positions are now concentrated in the U.S., where growth is solid, consumers will benefit from declining oil prices, and the central bank has flexibility. Quite a bit different now, but that was their main investment thesis. And then they dig further and further. There was extraordinary trading activity. The sell-off in oil continued. The market may have been concerned about illiquidity out there, and that's why you had some sell-offs. Or the global economy is too dependent on the U.S., or the European Central Bank lacks the ability to support growth. And they talk about the VIX and where that is out there. This is actually changing as well, even if we speak about it. But basically, they go through point by point by point by point. The recent sell-off was not due to fundamental changes in U.S. growth, and they talk about where the growth was and so forth. So anyway, declining oil prices and bond yields will support consumers. So anyways, it's just fascinating. There's a ton of different charts and why they're going to do what they do. And here's a guy who gives another opinion out there and so forth. So anyway, I find it fascinating that you can go get these essentially most of the time for free and give yourself a little extra information out there. The other one that I want to look at actually is crude oil. Morgan Stanley, if you think about it, maybe you don't remember, markets were pretty volatile in the oil market out there, and they had gone way high and way low, kind of where I think we'll be for the next year or so. But anyway, in 2015, the downturn in oil is going to get likely get worse before it gets better, I think. Without OPEC intervention, market risk becoming unbalanced with peak oversupply likely in the second quarter of 2015. Well, it really is about supply and demand, and that's my problem with oil right now is basically as long as the U.S. is refusing to go and produce, where we had brought up the world and created some of the supply that was keeping oil prices down, that isn't going to happen now, and it isn't something we can turn around on a dime. So I think they're even warning in OPEC that they will run out of excess capacity next year, which means oil prices will just have to rise with demand and so forth. So anyway, they talk about different things. Without intervention, oversupply is coming. Closing the gap may not be as difficult as expected. There's their new estimates for the base case, the bear and the bull case out there, previous estimates when they're going out there, and the change from that. So they're expecting to be quite a bit down from where they were expecting it to be just a year or so previous to that. But they analyze their own numbers and say here's what we missed and here's what we didn't, and I find that pretty fascinating too. Anyway, look at the beauty of the charts in the bull case and what's going on, the base case and so forth. With OPEC on the sidelines, plenty of headwinds in 2015 and so forth. And then they look at it kind of quarter by quarter and the drawdowns in stocks out there, not stocks, but the stocks / supply of oil and so forth out there. Anyway, it's interesting what it leads to, because it really is a supply and demand world out there when it comes to oil. But the depth of the analysis they give you is awesome. And I trust Morgan Stanley the most. So when Morgan Stanley just within the last couple of weeks said, hey, be careful, they think there's still the possibility of a sell-off in 2023, I give it a little more credence than others. I have my own opinion about it, but I give it a little more credence than others because in the past, to me, Morgan Stanley has been better at predicting certain things than some of the other companies out there. So anywho, comparison of the data is what you're really after. If you go back and look at the Rocky Mountain Investment Challenge or some of the CFA stuff, we're looking at the company data, the margins, and here's an interesting report on that down here. The margin is everything, income statement divided by sales, so you get where a percent of each dollar is being spent. The multiples of book value or earnings that they're willing to pay, and by segment you can actually do that and see where your firm ranks relative to the competition. This is exactly what the big investment houses do because I've stood behind them while they're actually going over earnings announcements live. So anyway, but it's interesting if we're going to use something like DCF, and there's several videos on there about DCF now, discounted cash flow. It is a multiplicative method in the sense that you'll take an earnings this year and grow it next year and the year after that and the year after that. So when the earnings this year changes, good or bad, it doesn't just impact this year, it's year 2 and year 3 and year 4 and year 5, and the growth being smaller means lower multiples going forward. So you get this kind of compounding effect where small changes can become a big price difference in what they think it is worth going forward out there. So do events like dividend cuts or layoffs. I did a lot of my dissertation on layoffs. We're seeing a lot of that here in the early part of 2023. In general, for firms that were reasonably financially safe and weren't in a lot of trouble out there, layoffs up to about 5, 6, 7% of the workforce are considered a good thing. And if you go look at the reactions to layoff at some of the major companies who were laying off somewhere near those amounts, you did tend to get a more positive stock return from it. What they're trying to do is create financial slack. Essentially, people cost money, and when you can get rid of people, you are cutting back on the money you're spending on that and creating, if you will, slack in the sense that the money will not be going to those people anymore, and it can be meant to cover interest expense or other things going on out there. But the big picture is margin changes are more important than revenue changes. Top line growth is important, but how much of each dollar you get to keep is actually more important, and they are interlinked for valuation. So let me go to this margin stall PDF, which is another fascinating one that came out recently. I actually really appreciate a company called FS Investments. While they may compete with us, JBA Wealth and all that, the bottom line is I think they have some really smart people there. And they talk about margin stall. Rising free cash flow margins have been the principal driver of stellar equity returns. In this report, we apply the quant lens to margin expansion, identifying low interest rates, declining tax, and sluggish wage growth among the top contributors. But they're not going to be declining taxes, you're not going to have lower interest rates, and you're not going to have sluggish wage growth going forward. So with margins under threat from deglobalization, higher interest rates, and inflation, the current moment appears to us a similar one for equity markets. And they go through some really great research down here. I give them 100% kudos on it. The end of the great moderation, the firms are not going to be able to let somebody else produce it around the world for cheaper. They're going to have to bring it back here and spend money on that. They are great capital expenditures are going to have to take place in that regard. They put them off for a long, long time here. The drought in business spending is both a symptom and a cause of the broader macro environment that's been dubbed the Great Moderation. Management teams have made an about face over the past 2 years as the business spending has surged. At the core of this reversal is inflation. Supply chain snags have driven input costs higher and laid bare the fragilities of today's complex logistic process, which is interesting because logistics has gotten a lot more complex, just kind of like just in time and all the rest. But when just in time doesn't work anymore, it works very, very poorly. Crucially, inflation has also changed the calculus for companies, pushing up the opportunity cost of putting off investment. There are long-term forces at play as well, including the energy transition, renewed defense spending, and robotics and automation. Single most important factor is they believe that the free cash flow will be impacted negatively. They call that margin stall. The secular increase in margins will be attributed to declining interest rates and so forth. They said, based on our margin model and medium-term macro, we believe free cash flow margins are likely to decline from their current levels, even if margins simply stagnate. At current levels, the ability for the equity markets to grow free cash flow at a persistently faster rate than GDP and corporate revenues has been predicated on expansion of margins. They believe that they may be drying up on that. It's a new era of investing. Free cash flow will be more important than ever. Anyway, the cohort of winners is likely to change in the coming years as some of the companies who have realized the benefits of margin expansion, tech firms and global manufacturers, most prominently among them, are likely to be in the eye of the deglobalization storm. Cycles are likely to be faster and more volatile. While all this may portend lower equity multiples and ultimately lower returns going forward, we believe it will offer a generational advantage for active managers with a deep understanding of free cash flow production dynamics. So great written piece. It goes on and on and on, by the way, with some great graphs that talk about it if you want to look it up. But anyway, fascinating research that makes it difficult in some ways to say who has the best info. But through the years, those have been some of the ones that I've appreciated the most. So the books tonight, I would say, is The Little Book That Beats the Market by Joel Greenblatt. Has been a constant one out there. It's worked pretty well for a long time. Return on Invested Capital and so forth. How to Make Money in Stocks by Bill O'Neill. Really fascinating guy. Created Investors Business Daily. Research really isn't any on this. And then I think this is a pretty good strategy tip. Keep an eye on what has carried markets recently versus what might carry them going forward, because I think it's possible, especially with this rolling recession from sector to sector and industry to industry, I think it is very likely to be a change in leadership and what's going to carry the market forward profit-wise in the future versus what it's been in the recent past. So thanks for your time. Appreciate you. Evaluation part 2 is over, and we'll see what's next. Bye-bye.